that is our mid-cap movers segment, but Lumax, that's the stock on our radar now. Q1 was a steady quarter for the company with revenue and profit registering good growth, but their operating margins, they've declined slightly on a YY basis. To discuss more on their Q1 performance, Anmol Jain, the MD at Lumax Auto Technologies, is joining us now. Mr. Jain, good afternoon. Thank you so much for joining in. Q1 has been steady for you. So is it fair to say you stick to your revenue growth guidance of 20 to 25% in FY25 and margins at 13%? Because there was a slight blip on a YY basis if we remove the other income component in margins. What's the margin outlook?
Good afternoon, Sonu. Thank you very much for having me. So number one on the forecast on the revenue, I think we did a pretty good start to the year with a 20% growth in Q1. My still guidance for the full year remains between 15 to 20% on a consolidated basis. We all have heard headwinds in the passenger vehicle space, which does account for 50% of the revenue pie of this company. So we are cautious but optimistic. So I think in Q2, we do expect a bit of a slowdown in terms of the growth rate. But for the full year, I would still expect a 15 to 20% guidance for the top line growth. As far as the margins grow, I think we've always maintained that we would first like to get to the teen EBITDA margins. And I think for the last many quarters now, the company has sustained almost close to a 14% EBITDA margin, which is what it reported in this quarter as well. And my guidance would be we would be able to sustain this margin going forward as well.
Just a follow-up on the guidance, revenue guidance, because the last time when we'd spoken to you in May, you indicated the revenue guidance could be 20 to 25%. Is the slowdown that you're expecting in Q2 leading to this slight cut in guidance?
So I would say that, yes, the guidance of 20 to 25%, we are just tapering down by 5%, primarily because of the volume offtake being low in Q1, and we are expecting in Q2 this trend to continue. So for the first half, I think the guidance would be lower. However, on a back of a strong order book and certain new models and new product introductions, which primarily go in H2, we are hopeful that H2 would be a much better growth 2 quarters for us. So for the full year, I would still say close to 20% should be doable. But yes, for the full year, it would be definitely slightly revised from my earlier guidance by about 3 to 5%.
Mr. Jain, thank you so much for the clarification on that front. Even OEMs have mentioned that the passenger vehicle market has seen some slowdown. Now, coming to one particular segment of yours that's doing quite well. First up, if you could confirm where your current order book stands at. We understand it stands at close to 1,000 crore at the end of Q1. Secondly, how is business shaping up as far as the IAC subsidiary is concerned, which primarily does work for Tata Motors? We understand that particular segment has been doing quite well. Give us numbers in terms of what is it that you're guiding the street for.
So number one, Vivek, on the order book, you're absolutely right. The order book as on Q1 stands at about 1,000 crores. I would think in this year, about 25% of this order book would come into the revenue stream already. And almost close to 50 to 60% of it would come into FY26. A large part of the order book, close to almost, I would think, 70 to 75% would be in the passenger vehicle space. And clearly, we expect a larger piece of the pie of the revenue going forward to be from the passenger vehicle space, because the content per vehicle in a passenger vehicle is much more than that of a two-wheeler. So strategically, that's where we want to position the company. Specifically talking about IAC, just one correction, IAC's largest customer is Mahindra and Mahindra. While we do some amount of work for Tata Motors as well, but Mahindra is the largest customer there. We are pretty bullish. Out of this 1,000 crores, almost 400 to 450 crores of the order book rests with IAC India. For the first quarter, IAC also saw a 19% growth in its manufacturing revenue on a year-on-year basis, which is pretty much in line with Mahindra's own growth of 15%. But we do continue to expand our footprint of customers in IAC India. We are in discussions with multiple other OEMs to expand our wallet share. So pretty optimistic, because going forward, the interior space of a vehicle, which is where IAC operates, is going to massively transform into becoming roomier, the smart surfaces, sustainable materials,
Right.
lighting. So we're pretty excited about IAC India going forward.
Mr. Jain, what I meant to ask is, from Tata Motors specifically, what is the kind of visibility that you're seeing? Also, we understand that you are on the lookout for inorganic growth. Have you zeroed in on any acquisition targets?
So Tata Motors continues to be a strategically important customer. I think only about close to some 5 or 10% of the revenue of Tata of this company comes from Tata Motors. But I think the growth prospects of Tata Motors with this company are huge. Because of its diverse product portfolio, we are engaged with Tata Motors on multiple products for their forthcoming platforms. In terms of your question related to
inorganic growth, inorganic growth.
Inorganic growth, I think, Vivek, we always kind of been on the lookout for. Currently, also the company is evaluating 2 to 3 opportunities. These are, areas which the OEMs are in need of, or which are strategically a good fit to our core competencies. So I would assume that probably sometime later this year, if some things fructify, I should be in a position to give you more information. But yes, we continue to be engaged for inorganic growth as well.
Is there a kitty that you've set aside for acquisition, since you're saying something could be finalized this year itself? And what does that do to your debt? Because there was a plan to cut debt this time. How do you plan to fund the acquisition if something does fructify this year?
Well, Sonal, happy to share that the company is already sitting on free cash of more than 400 crores. So we have a pretty strong, pool of resources internally to invest and do in inorganic growth if required. But I think apart from that, the debt equity ratio is quite healthy. So the company does have enough capacity to raise debt if it's needed in the future.
Thank you so much for your time, Mr. Jain, and answering all of our questions patiently. We'll get you once again on the show when you do make that acquisition that we've been waiting for. Let's now slip into a short break. When we return, we will be joined by the management of Anmol Technologies to discuss the Q1 numbers and the way forward.